Thanks so much for tuning into this conversation. A quick check at the monthly sales numbers by the auto companies declared yesterday and today would suggest that the CV numbers are looking strong across OEMs. iShare had a fairly decent release. Tata Motors, while passenger vehicles didn't do well, the CV numbers looked okay. And Ashok Leyland came out with a fairly strong set of numbers as well. We know that the commentary from the forging companies, which have a larger CV market share, are talking optimistically about the Indian numbers, cautiously about the global numbers. But post the numbers that have come out thus far, I think it's important to take stock of the situation of how the quarter gone by has been, not exactly numbers terms, but in terms of the texture of growth and what is the outlook for 2023 like. And in that, today on this show, we're talking to Mr. Vidyashankar Krishnan, who is the Vice Chairman and MD of Forgings. It's arguably the third largest forging company with a fairly large market share in the CV segment. Mr. Vidyashankar, thanks so much for joining in. Hope all is well. Wishing you and team a very happy 2023. You reckon 2023 would be a happy year?
First of all, thanks for the wishes and wish you and your team a very happy new year too. And all those who are listening to this channel. Let's hope at least 2023 turns out to be a more peaceful year than the last 10 months of 22.
Most certainly. But in terms of business terms, how are things looking? Because the CV numbers look pretty okay. I mean, what is your experience?
Our experience has been very positive. We see significant growth in the CV segment in India. And surprisingly, we are also hearing that the CV segment might do well in Europe and in America as well in 2023, which is really contrarian, and it even surprises me.
Are clients talking that language as well?
Yeah, that's how we are echoing it or rallying it. The news from there is pretty upbeat. So I would say it's worst case. It's not going to be doomsday, at least for suppliers to the CV markets from India. So it's not going to be, you're not staring at the wrong end of the gun.
Interesting. So, okay, let me try and kind of drift this a bit further. So Q1, we saw an extremely positive quarter from your end. I presume the highest ever revenues back then in Q1. The outlook then was looking strong. I'm a bit surprised because I thought you would have said that we are positive about Q3 and Q4, but that is on account of the domestic order book and not so much about global. And here you are telling me that the global is actually sounding upbeat. What could be the reasons for this? Because almost across all macro signages that we see or signposts that we see, we're looking at a sharp deceleration in the US and a near recession in Europe.
I would agree with you that definitely our Q1, Q2 and Q3 performance, Q4 as well, will be has been driven by domestic and will continue to be driven by domestic, no doubt about it. But the latest news from our customers and their planners is that 2023 is going to be slightly better off than 2022, which is very, very contrarian.
Wow. Okay. So let's
good news. So it's no, we're not crying about it. Let's be very clear.
I'm sure you're not crying, but I'm just trying to understand from your experience, because you have so many cycles
for that
experience.
Are quite manifold. What we understand is aging fleets, basically in Europe and US. See, those countries are not like India, where you can pull along a truck for a couple of more years or beyond a couple of years in terms of maintenance. You've got to look at replacing fleet beyond an age. Otherwise, maintenance costs are unsustainable, are unviable. The labor there being pretty expensive. So that is probably the single reason that we are being told, which is good. However, fingers crossed, that's the positive side. The negative side is a recession and the whole dismal, gloomy macroeconomic conditions in Europe and also in America. So we'll have to see how this pans out. But I would say a week back to now, definitely US and Europe aren't as bad as they were.
Which is music to the ears, I'm sure, for
Really,
companies
really,
like yours.
at least with the CV segment.
Of
See, we
course.
should also look at economic cycles differently. Back in 2008-9, when the Lehman crisis hit, global US economy, for example, contracted something like 3 to 4% max. I might be off by 1 or 2 here and there percentage points, but roughly 2% is the norm. If you are a bit charitable, let's say, or take a worst case, 3 to 4%. But manufacturing went into a nosedive. So to some extent, there's decoupling between the two, because manufacturing was an all-time high in terms of inventories. Whereas now, the other factor is that most companies are running their pipelines lean, because they were buying heavily in the first half of 22 and found that in the second half, shipping transit times came down. So in the second half, they were suddenly faced with a lot of goods on the water, as we call it. So they were looking at the cut down. 70-day shipping times came down to past good old 35, 40, depending upon your liner and choice and all that destination, but broadly within 10 days of previous levels. So that has meant a huge cut in the buying of these companies, tier 1s and tier 2s abroad. Now their inventories are also rather on the lesser side. So they, looking at all this together, they seem to be of the opinion that 23 will be pretty strong.
Okay, so let's hope that happens.
Yeah.
If that doesn't happen,
Yeah.
how strong is the domestic picture looking like? I mean, the recent numbers are looking buoyant, at least from the CE companies. What has been the experience at Forgings on the domestic side?
On lines with what the market is seeing, absolutely the same. We are seeing tremendous demand in terms of the domestic market, no doubt about it. Some are up, some are down. I won't comment on that, being my customers. But broadly, I would say the market trends are echoed within our 4 walls. So in terms of dispatches and production planning, everything, you're seeing those, whatever introduction you gave, you're seeing things on similar lines.
And are the sound bites sounding strong for 2023 because of the
They're very
capex
strong
drive,
for
so on and so
Q4.
forth?
They're very, I would put it this way, they're very, very strong for Q4. Everybody is expecting a strong Q4 and much stronger than Q3. And still, I feel that there is much more domestic play left, because the next year will be a pre-election year, and we expect some amount of spending to take place. That will in turn drive goods and infra, which in turn will mean more mining trucks as well as haulage. Both will improve.
Okay.
So 23 appears to be very positive from an Indian point of view. The shadow in this scenario will be what will be the impact or the extent of impact of a slower situation in markets abroad.
But if it turns out the way,
but if it turns out the
you
other way
spoke
around,
about,
then it's, so I would say exports looks at least worst case stable and doesn't seem to be plummeting, which is, I mean, it's really, I wouldn't hold the same view, Neeraj, for PASCAR dependent organizations.
Sure.
PASCAR, I'm sure, will be the other way around, because as energy costs bite purses and wallets, certainly buying of PASCARs is already, people are seeing huge cuts thereby. So
right. So I'm thinking, as I look out at 2023 as a calendar year, I know the financial year is different, but as a calendar year, while you may still have a higher base effect on the revenue front because your Q1, Q2, etc. all look strong, I'm presuming Q3 would be looking strong. The raw material cost base for 2022 would have been very high, and that would normalize in the subsequent in this year, which might help your operational metrics on decent sales for 2023.
tough call Tough call. Yes, definitely those inflationary pressures of April are not there now. That's 100%. There's no stopping that. It's very clear, apparent. But what is happening is that coal, particularly our raw material is steel. So if we get down to that, coal is a joker in the pack. It seems to be concentrated in the hands of a few countries, few companies, and dependent upon floods in Australia, and any little thing upsets coal. China's uptick, coal goes up. China COVID, coal goes down. So coal is a joker in the pack, as I see.
Got it. Just a little bit about your own plans as well, independent of what the market is saying, because I think you're expanding capacities. You're looking at the EV segment as well. Tell us a bit about it.
This year we should end up around the 70,000 ton, not around, into the 70,000 ton range for the year in terms
as
of
a capacity.
In terms of overall production on a base of 120,000 tons.
120,000, yeah.
We expected to add 10,000 tons this year, but our price is probably coming a little bit slower. So we'll probably do that by Q1 stroke Q2 of FY24. So a little bit of a delay, but anyway, even had it come, it would have been only a nameplate capacity. It would have not gone much into production. So effectively, it'll be coming into production in FY24. So our capacity remains at 120,000 tons, and we see next year we will surely end up at 130,000 tons of boilerplate capacity, on which we should do anywhere between 90 and 100 plus. This year we would end up around 75, give or take 3,000 tons. 72 to 75 would be a conservative number, would be a realistic number. And next year we should do 90 to 100k tons.
That's between 30 to 40% growth.
That's about, if you take 75%, 75,000 tons, easier number is 90 represents 20%.
Yeah.
So quick, this thing is 25 to 30% growth.
And this optimism is on back of domestic business
largely
doing
on the
well.
back of domestic. Our expectations are largely on the back of strong domestic business.
Any newer avenues?
We have gone a lot into agri and farm equipment. So I had even earlier said that we'd be looking at 7% odd from them, from the agri segment. I think we've done better than that. Yet to see the final numbers for the quarter, but indications are that we would have crossed that 7% mark.
I thought rural was under a bit of pain. No, not really.
Agri, farm, tractor doing reasonably well. No issues there.
No issues at all. Okay, that's good to know.
Good harvest so far. Nothing nothing, and people are all talking of a stronger harvest in the months to come, and a good season for cars as well. Four-wheelers are on a roll, so that definitely means that rural India is doing pretty strong, despite higher interest rates.
Yeah, no, passenger vehicles are coming off a little bit, but I think that the SUV segment seems to be doing okay. I have one final question. Sure. Would you believe that with that 130,000 capacity in place, you're done with capex for the near term? Because even if you move up to 90,000 or 100,000, you still have utilization which is not near 70-75. So no pressing need to add up further capex, I reckon, despite strong growth.
Yeah, good question. See, what has happened is over the last few years, the nature of Forgings has changed. We have clearly transited from being a forge shop that supplied hither and thither a part which is machined to being a supplier of components. So our investment this year and the next year will be focused on machining largely. So value added downstream operations. So we are increasingly becoming a component supplier and not just restricted to a supplier of forgings. And as a result, our focus on investment is skewed largely towards machining and getting into assemblies. Now, assemblies is not yet started, but we guess we'll make 1 or 2 baby steps in the next 12 months there. So from forgings to components to possibly parts, fully usable sub-assemblies. Also, the EV plays strong quite over there. We're looking at supplying motors to start with, and possibly finished e-axles. So all that means that we'll be making a big transition. We are already transiting as on the forging side itself, and even on the new products on the EV product side, we will be transiting. That's clearly the position itself starts off with sub-assemblies, the product. And
So
then
that means
product, we could go to subsystem.
Mhm.
That will be the transition there. We're starting off with the product, but very quickly, due to customer interactions and customer requirements, we will quickly move from parts to sub-assemblies.
Okay,
Subsystems
sure.
from an assembled product, not part, sorry, from product to a vehicle subsystem, like an
Which,
axle.
which means on the capacity front, you will,
That will be largely on the EV side.
but you will keep on expanding
Yeah,
capacities.
we'll keep morphing.
Okay. So 25%
So it's
growth
early
in
days
FY.
yet. It's early days yet for me to look at what kind of numbers, etc., etc. But that's a direction from what I hear from customers. Clearly, that will be the direction, and we're preparing ourselves for it.
No, so but here's my question. Strong FY23, maybe 25% average growth FY24 over FY23. Are there some 3 or 5 year targets that you set for yourself? CAGR growth targets?
I would say doubling ourselves from where we are
in about 4 years?
In about 4 years, 3 to 4 years.
3 to 4 years. Okay.
On the lesser side of the spectrum, and also the other economic play in India, which is a huge trend. What Modi ji has unleashed is a huge, make in India, defense procurements from within the country. I believe, along with many other CEOs, that our growth we are a $3 trillion economy, and we are headed towards 5, 7, 10. Now, whether that happens in 7 years, 10 years, 15 years, each milestone, but we are headed only one way. That's for sure, up to 2040. So there's a lot of things that we as Indians have to be prepared for in terms of changing the way we do business. Our aggression levels have to be much higher, and at the same time, we are by nature pretty grounded. So keeping that grounding, we have to move faster.
You'll move fast without altering your debt equity. Sorry? You'll move fast without altering your debt equity too much.
To some, yeah. Anyway, we are being grounded. We will all take what shall I say, cautious measures on the debt side. So possibly, yes.
Got it.
Well, so there's a lot of bullish things happening in India, and I'm very sure that as the economy grows, we being a CV dependent organization at Forgings will grow on the back of the overall economic growth. Agreed, highways are making transport faster, efficient, but that's also part of growing. Hey, when you grow from 3 to 5 to 7, 10 trillion, you shouldn't grow inefficiently.
Most certainly.
Better to grow. Of course, the electricity sector is one that's possibly pulling the economy down. I'm sure people will find a way out.
Yes, most certainly. Well, it was lovely talking today to understand some bit of this, and once your numbers come out, we're lovely to talk some numbers as well then, sometime in the month of Jan or Feb. So looking forward to that. Thank you so much for talking to us today.
Thank you. Wish you all a very happy new year.
To you as well. And viewers, thanks for tuning into this conversation.